The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. If you're enjoying these podcasts, please subscribe. Make sure you're always getting the latest and greatest that are coming out. And feel free to forward these on to your friends and family and coworkers and let them share in a little bit of this information we're putting out here. Thank you so much for that.
So this session is called Oops, Not Again, because that references what makes a good financial advisor. Somebody who's made a bunch of mistakes in their own account and have been through several bear markets to understand the real pain that clients are experiencing. It's one of the problems that today's financial advisor community has is that the older guys who've been around a while are retiring. You're getting out of the business. And the industry keeps recruiting new people who've been to college, don't have much money, they've never invested anything or have very little invested. So when the market, and they're so young, they've never experienced a bear market.
It's true. It's a big deal. It's a really big deal. You know, Don, that just reminds me, I just got finished reading an interview that had been done years ago with George Harrison of the Beatles. And when he started writing songs for the Beatles, which was much later and way after the Beatles were already a national phenomenon, he said, my big disadvantage is that McCartney and Lennon, they've already made all their mistakes. They've already written all their terrible songs. I still have those. I'm brand new. I'm going to write I got to write the bad ones still. And I got to write the bad ones as a member of the Beatles. So I'm just going to go ahead and do it and get through them. But they've written the bad ones. They've seen them. They recognize them all when they're coming. That's really important. That translates quite well to being a financial advisor. You know, there are these pitfalls out there just waiting for people. And with enough time and enough history in the market, you can see them coming. And some of them you can safely sidestep. Everybody's going to get blindsided from time to time, but that experience does help avoid the big ones and the easy ones to see that not everybody sees the first time around.
So some of the mistakes are just annoying.
Yeah.
They rub you in the rib. Somebody, your spouse, reminds you, if only you had, and fill in the blank.
Right.
You used to own NVIDIA when it was just a gaming company, and you sold it a couple of years before ChatGPT came out.
Sure.
And you're looking back and saying, if only I still had.
And you probably made money anyway, but you could have made a lot more, and that's just annoying. You know, I didn't get hurt. I did okay, but boy, I could have had a really big one there, and I missed it. And those are the kinds of things you kick yourself for often.
Another annoying one is thinking that you're a Warren Buffett investor, long-term hold, and you bought something at the top of the market and you go through an extended period of losing money and then an extended period of trying to get even. And you sell it, you still take a loss. It's not that big. It doesn't destroy your fund. You're not going bankrupt with it.
Sure.
But maybe you don't want to be an investor who lives to be 100 in order for everything to work out right.
Yep. And then you begin to understand that. And those are the kinds of things that can paralyze people too. You can have that little annoying mistake, and all of a sudden you get real hesitant to do anything anymore. You know, say you were trying to invest like Warren Buffett, and you lost 30% in one position, but you could have gotten out with a 15% loss, and that 15% just haunts you. You can't get it out of your mind. And the next time it's time to buy something, you'll pass because you're afraid you might lose again. That's the other side of those. Even if it's not part of the same transaction, it can still affect you if you keep thinking about it in the wrong way.
That's called hindsight bias.
There you go.
That undermines your future progress, which is one of the reasons why you should have rules. And when we run our portfolios on a rules-based process, we have we have a maximum amount of time that can elapse before it's a forced review to be sure that we still own leaders and not laggards. If something's starting to go in the tank, you want to get rid of it instead of hanging on to it. Or admit you're a buy and hold, and if you lose 30 or 50% in a couple of years, it's not a big deal. But
Right.
you're probably lying to yourself, or you're
Right.
going to lie to your
Right.
spouse. You're not going to tell them about
Or
it,
both. Yeah. Yeah.
or both.
Yeah.
So that, and the industry uses a rebalancing process to try and avoid that. Basically, I've got some winning positions here. I was only supposed to have a 20% allocation of this asset class, and it's now 25. So I'm going to sell some of that. I'm going to sell that 5% and go buy the other stuff I own that's sucking wind. Well,
Right.
that's the industry mantra. That's called rebalancing. Our
Yep.
position is why buy the stuff that's losing? Wait until it turns around and you know that it has a bottom in it. Then go back and put your money in it. But when you do rebalancing, you inherently create the problem that we started off with of selling winning positions too early.
Yep.
Think about that. I'm going to sell my winners and buy my losers. That's my investment process. That's what modern portfolio theory is, and that's what the financial industry sells. Wherever you go, 90% of the offices that you talk to use a balanced portfolio structure of some sort based on answers to questions that they ask you, which
Right.
means you're structuring the portfolio, not them.
That's it. And the reason they all use that process is because it's easier for them, not because it's better for you. They get to do almost nothing. They can just hold your hand and explain to you why we're selling this great stock that's getting great returns, and we're going to buy these dogs over here that are doing nothing because at some point in the future, unknown to us, we believe it's going to turn around. In the meanwhile, we're just going to keep talking to you and holding your hand to make sure your money stays here. But what we're doing has got nothing to do with your investing success. It's got to do with keeping your dollars in our firm.
So some mistakes are serious. I mean,
Mm,
I want to go back to the 2000 tech bubble.
yeah,
Uh, I can actually go back further than that. I can go back to 1987 with Black Monday. And at that point in time, I had no technical training. I was a broker, and I
right.
basically my job was sell investments. Well, the market started going down in October. I think it was October 13th, Black Monday, and then it bottomed on December 3rd. So it was only a 3 month bear market, but it was a significant decline in price. And the emotions of that decline got to me, and I sold stuff. I think within a day of the bottom of the market, I just the pain was too much to
Too much.
bear,
Yep.
and I
Yep.
didn't have rules that said you've lost this much off its high. Do you know what you're doing? It's time to get out. Protect your capital. Well, that kind of not having that kind of rule or checkpoint, not going back and seeing where you stand and knowing what you're going to do when the bad stuff starts to happen is possibly one of the most serious mistakes you can make, because the pain will reach a point where you say to yourself, no more. I cannot
It's too
take this
much.
anymore. It's too
It's too
much.
much. And that's the problem. We're all human. And if you don't have some rules that are going to act as guardrails for you, essentially, you're going to act human also. Everybody will at some point, and you're going to get way too happy if everything's going great, and you're going to be way too depressed if everything's going poorly, and you're going to make bad decisions because they're going to be highly emotional. And that set of rules, that baseline of rules, can keep your head clear, let you make better decisions when things are either way too good or way too bad, and let you see things for what they are instead of feeling one way or the other about the market. And that's when you're going to tend to make the biggest mistakes you'll ever make, is when you're playing it by feel. Well, my gut said to do this. It's usually, well, that's almost always wrong. Don't do that. So, but you have to have those rules in place prior to those events coming up, and that'll let you see more clearly and make better decisions during those tough times.
Well, you mentioned the gut reaction to the market, and I'm going to go back to 87. I don't remember the lady's name, but she was a big wig at, I believe, Shearson, who in the months before October 87
Mhm.
told her clients to get defensive and get out of equities. And I mean, she called the market top, and she got
Okay.
pressed as being the genius of the year.
Right.
The problem that she had is that the market dropped in 3 months pretty quick, 30% drop, 34, I think. She had such success from that, and the drop was so severe, she was afraid to get back in. It was a
Aha.
gut reaction that got her out, and
Right.
it took her 2 years of market recovery and advance before she finally told her clients, well, we should be in the market.
Right.
So this is where rules are important. What are your rules for actually making those decisions? If you don't have them, then you're a buy and hold investor and you're saying, I'm willing to lose a lot of money when the market collapses the next time, whenever that
Right.
time happens to be. And we
Right.
don't know when it's going to be. All
Nobody
we
does.
know is
Yeah.
the rules that force us to do a regular check and say, should we still own this? Is it still a viable position relative to everything we can buy? Is it viable? And if so, it stays in the portfolio. When it's not, we sell it. We've both been married a long time, but we're not married to what's in the portfolio, whether it's ours or our clients.
Yep, it's a bad choice. And having those rules, that level of clarity that rule base will enable you to look at the market with can really change everything because the emotional response is what really gets you in trouble. And if you have those rules that you can look at and say, hey, wait a minute. This really isn't as bad as it sounds or as bad as it's being made to sound by the financial press. I think we're going to be okay here. And the data says we are, and that will let you stay there. And that doesn't mean you're always going to be right. Doesn't mean that data is always right. But most of the time, if the probabilities are going to be in your favor, it's going to keep you on the better side of most trades. And that's the best you can hope for in the market. Nobody's going to be 100% accurate, but you want something that's going to give keep the probabilities on your side instead of if you're trading emotionally, there's no probability you're ever going to be right. It's just a shot in the dark every time. And with that baseline of rules, you have that chance for some clarity and to stay on the probable side of being profitable.
Then there's some mistakes that are really end game disasters. And
Yeah.
that's usually because in today's world, it's easy to get caught up in a scam online. You don't want to do
True.
anything there that you don't know the people, you don't know the firm, you can't verify that. And even
Yep.
verifying it online may not be sufficient. There's a lot of fake websites there. Or you get caught up with wanting to buy into a return that is so much better than anything else you've ever seen or heard. And it comes
Yep.
with a guarantee, like it's guaranteed 15%. No, no, it's not FDIC insured, but it's guaranteed and it's been there for several years. We've just been doing such a great job. Um, the name that slips my mind, the guy that started with him and went to jail, the big scam of the last
Oh,
decade.
Madoff. Ernie Madoff.
Madoff, yeah.
Yeah. Yeah.
Uh, oh yeah, phenomenal returns year after year after year. You just don't lose money with this guy. He's so smart.
Clockwork. Yeah.
Well, he's so smart at printing out fraudulent statements. That's what he was smart at, and you lose your money on that. So when it sounds too good to be true, that's a good time to turn around and go the other way because
Absolutely.
those kinds of mistakes can have a substantial long-term detrimental impact on your financial well-being, and if so, your physical and mental health at the same time. Uh,
Absolutely. And that's not the kind of thing you want to get wrapped up in, especially if you're already in retirement. That's no time to take a big chunk of your retirement portfolio and say, well, if I could double or triple this in the matter of a few months, I'm going to do it. Too much risk. You always look at the amount of risk that's involved in the decision you're looking at. And like you said, Don, the main thing is if it sounds good, too good to be true, believe it, it probably is. And back up a minute and see what's going on, and you're going to see probably, oh, I see what they're doing. I don't want to go down that road. And it can save you a fortune, especially when later in retirement. You can't afford that big mistake. You're not going to have decades to build that fund up again. So you don't want to give it away to a scam or a charlatan there at the end.
So if you enjoyed what we just shared with you, you probably have friends, family, or coworkers that have similar interests. We'd appreciate it if you would share the link with them. Let them know that we do these. Subscribe to our podcast. If you want to listen to us about the market specifically and where it stands each month, we do a webinar on the first Saturday of every month. You can go to our website to register. That's the shortcut is IRI, that's 3 letters, IRI radio.com. It's an easy registration. If you can't attend on Saturday morning, you'll get a replay link. You'll know where we are, what we're thinking about, what's going on in the market, and you'll see what we've done to update our portfolios at that time. Thanks for listening. Share the link and have a great day.